The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. Getting started a couple minutes late here, so thank you for your patience. I'm Carly Rogers. I'm CAPSA's Marketing and Education Manager, and welcome to the 2015 Global Copper Market Outlook webinar. Our presentation is sponsored by ABC Metals. In this annual presentation, we'll look at the 2015 copper market, including global, regional, macro developments, supply-demand fundamentals, and pricing. So lots of good stuff coming your way. Before I introduce our speakers, I'd like to go over a couple of housekeeping items. If you do have a question during the presentation, go ahead and submit it using your toolbar. I don't want you to forget those questions, but we will answer them for you at the end of the presentation. We'll send out a survey to you 1 hour after the presentation ends, and that survey, at the end of it, once you've completed it, will be a link to download the PDF slides, so you will get a copy of it. You'll also get a recording of the presentation, and that will be posted on CAPSA's website and CAPSA's YouTube channel, and I will also email and let you know whenever that recording is available. So I'd now like to introduce our speakers. Richard Aldrich and Andrew Jones are with us today. Richard joined GE Capital in 2004. He is the Director of Industry Research for GE Capital Americas, and he leads a team of analysts in support of underwriting and origination. He was a Wall Street Journal All-Star and Best on the Street analyst in both metals and steel categories for 5 years in a row. So very excited to have him with us. Richard's going to cover the first part of the presentation, and then we'll turn it over to Andrew Jones. And Andrew has over 15 years working in the mining industry in a variety of roles and commodities. He's held senior roles in both underground and open-cut mines and practical experience in a range of operating environments. He's currently the industry director of the base metals team for AME Group. So without further ado, I would now like to turn the presentation over to Richard, and he is going to take control here.
Thanks, Carly.
Yeah.
Let me just...
I think it should be with you.
See my mouse following. Let's see if I can get it to advance.
Okay. You might have to... Actually, I just stole from you, so you might have to double-click to get it back.
Okay. I have to double-click?
Yeah, you may need to if the slide doesn't advance right away. Okay.
All right. That looks okay. Disclaimer, you can read that at your leisure. See, there we go. So good afternoon, everyone. What we thought we'd do is kick things off with a look at some of the big picture macro drivers of copper, which I'll cover, including general consensus expectations and so forth. To Andrew, who's going to dig down more deeply into some of the specific fundamentals of copper, the supply outlook, demand, cost curve developments, and so forth. So that's the agenda. So starting with the global macro demand side of the picture here, I've plotted the year-over-year percent change of the OECD's global composite leading indicator, which is the gray dashed line, versus the year-over-year percent change in global steel production, which is the blue line, and the year-over-year percent change in quarterly copper demand, according to the World Bureau of Metal Statistics, and that's red. Couple things to point out here. First, you can see that the OECD's CLI is pretty well correlated with global steel production, with about a 3 to 9 month lead. However, for copper, the correlation is significantly weaker. For example, if you look at recent data points, you can see that the global CLI is sort of hugging that zero line through most of 2014. And steel demand growth has likewise been really pretty modest and shows really no momentum. However, copper spiked into the double-digit growth area in the second half of 2013 and through the first half of 2014. So, the question is how much of this double-digit growth is, real demand versus hidden inventory accumulation by the likes of, the China's State Reserve Board and others. And, this remains a real point of debate among analysts, where is the balance in the market. If you look at what the International Copper Study Group shows, they have a global copper market deficit of over 500,000 tons year to August, even after adjusting for their estimates of changes of unreported stocks. However, other industry consultants show the market in significant surplus of over 100,000 tons in the first half of this year. Steel and copper aren't a perfect match, but they do share end markets. And looking at steel production trends, which would appear to be less distorted by sort of government stockpiling and inventory financing schemes and so forth. You see slow growth over the last year or so, and that suggests that hidden inventory swings may have been significant of late. We'll look to Andrew and his commentary later in the presentation to shed some light on what's going on here. Here I just thought I'd show our GE economists' latest global GDP forecast by major region, which shows a very modest uplift in global growth overall. Now this forecast was done back in November, so in theory there could be some more lift from the recent collapse in oil prices. I've heard it said as a rule of thumb, something like $10 a barrel equals 0.2% in peak growth. Assuming over a long enough time you got the price down. So, maybe there's some upside to those numbers. Certainly, it looks like the U.S. is well positioned to see growth accelerate the 3% mark next year from 2.2% this year. And while there's a lot of churn underneath the surface, including modestly slow growth in China in 2015, our economists see the developing economies growing a little faster actively in 2015. Of course, China represents an outsized share of the copper market, accounting for about 40% of global demand. So developments there will be critical, obviously. Here you can see some of the key indicators we track. In the top left there, you got fixed asset investment and industrial production growth, which are both key metals demand indicators, and you can see those lines coming down as growth continues to slow. The PMI index remains in the doldrums there in the bottom left. Passenger car sales growth has been slowing. It had been, incredibly strong, and it's come down to single digits, low single digits of late. And the composite leading indicator, which you see in the bottom right there, went under the 100 line, although it does seem like the latest data point suggests that maybe momentum there is stabilizing. For our part, we really aren't so bearish on China per se. We do see GDP slowing perhaps to 7% in 2015 from about 7.4% this year. But, and that's by design to some extent, as the government tries to seek more balanced growth. Over the medium term, in the next couple of years, we think China can avoid a hard landing and maintain growth in sort of that 6 to 7% growth rate range. Of course, one of the fallouts of the strengthening U.S. economy relative to other parts of the world is the strengthening U.S. dollar. And here we show the inverse of the dollar index against major currencies versus the PPI index of the steel and base metals combined. And you can see there's a very strong inverse correlation with the dollar. So the recent strength in the dollar here is shown as the line declining because it's on an inverse basis. And that's, a function of most commodities being priced in dollars. And given the continued relative upward momentum in the U.S. economy, we expect that the dollar strength will continue to be a headwind here for metals prices going into 2015 and probably even into 2016. So here I just thought I'd throw up kind of a summary of some of the key factors driving the copper price, some of which Andrew will drill down on. Near term, again, we think the supply growth, slowing Chinese growth, a falling cost curve as oil prices decline, and a stronger dollar will collectively continue to weigh on the copper price. in the near term. However, longer term, supply side issues are likely to once again plague copper, both as existing mine ore grades decline and costs rise once again, and also reflecting insufficient investment potentially post 2017 due to the in part to the currently weak copper price. Also, while we see the market in surplus, we don't expect inventories to build, to very high levels like we've seen in some of the other metals like aluminum and so forth. So, while it's a surplus that we face, over the scheme of things, it's still relatively low copper inventories out there. So, once things turn, copper price could head higher without too much of a worry of overhang. Finally, I thought this is the quarterly average copper price over the past decade with the mean high and low analyst forecast as compiled by Bloomberg as of about 2 weeks ago. These consensus estimates tend to lag reality by a little bit, so my view is this might be a little bit optimistic in terms of the real-time view of where analysts are at, but basically it suggests the mean is sort of flattish copper prices out there in the 6,800 per ton range versus I think we're below 6,500, 6,300, something like that a ton right now. So, I'll turn it over to Andrew now at this point to kind of dig a little bit deeper into some of the stuff we've been talking about. Andrew, you want to take it away?
Yep,
yeah, sure. Thanks, Richard.
Let me get it switched over to you, Andrew.
Great. I think, Carl, you've turned it over to me on my screen as opposed to giving me control of your computer.
Oh, goodness, I'm sorry.
It's okay. I had everything cleared off anyway.
You hadn't shown it yet, so we're all good. All right, here we go. Okay, now you should have it.
Here we go. Oh, I look to have skipped a couple of slides there. Are you able to go back one, Carly?
Yeah, let's see here. Do we need to go back? Make sure I have it. Okay, are we on? Is this our last slide? So we are right here?
That's it.
Okay, perfect.
Great. Thanks, Carly. Thanks, Richard, for that first half. As you've said, I'll push on with some of the details on the supply side and the demand side. We've seen this year prices have fallen as there's been some concern regarding Chinese growth in the short to medium term, notwithstanding some of the infrastructure programs that China have put in place in the power and railway space to offset some of the real demand in the property market. We saw some SRB purchases earlier this year on some price weakness, which went a long way to removing what could have been a more substantial surplus this year. That said, we see prices under some level of pressure from the supply side as projects begin to commission and go through their ramp-up phases, and consequently we've seen some TCRC price rises over the year, and we feel they're likely to stay higher, particularly when we saw a spot TCRC earlier this year, or back in November actually, $120 a tonne, and this has had a lot to do with Indonesia beginning to re-export copper concentrates after the ore ban was enacted earlier in the year, and then there's been some growth in Mongolian copper concentrate exports as well. So we see TCRCs, well, recent contracts were settled at $107 a tonne between Freeport and Jiangxi, which have broadly been about 15 to 20% higher than the TCRCs arranged for this year. Okay, this is how we see the refined copper market balance unfolding over the next 15 years. Actually, it's I suppose it's our methodology to assume that the markets will balance by 2019. Up until then, we see the market being in surpluses, particularly over the next year in 2016. And then in subsequent years, the surpluses really die down to sort of that 200 kiloton region, such that any delay from one of these sort of larger projects, which we're seeing in South America, have the ability to turn the market into balanced or potentially into deficit earlier than what we're expecting. So we're expecting nearly 1 million tonnes of additional refined copper coming into the market over the next couple of years, and this allows for delays in the DRC, which we see as being particularly problematic on an energy supply side, and China itself introducing energy restrictions regarding the size of copper smelters. Only projects over 100 kilotons per annum will be getting approval from the government going forward. So this will obviously take out a lot of the smaller producers. And these medium to large size smelters will be using the more modern flash smelting technology and enjoy some benefits of scale there. Over the next couple of years, we see the better part of 2.5 million tonnes in mining capacity coming onto the market. Some of the larger projects will be Glencore's Las Bambas project, which they recently purchased from MMG, and First Quantum will be bringing a couple of projects online between Cobre Panama in the latter part of the medium term, and Sentinel as well, notwithstanding some of the royalty issues in Zambia at the moment. So all up, our base case assumes delivery of about 580 kilotons of new refined supply capacity next year, which is around about 2.5% of global supply next year, and then an extra 1.2 million tonnes of new refining capacity over the next over the 2015 to 2017 period, equivalent to about 10% of current global supply. There is some potential for rising capital costs for capital smelters, with governments looking to tighten up environmental policies, particularly around the reduction of SO2 emissions. It you know, there's a bit of a two-way street there, because that does actually generate sulfuric acid, which will offset some of those costs of having to scrub those emissions, so they can actually generate a saleable product there. So basically, the surge in refining capacity indicates a continued expectation of growth in both the concentrate and finished product demand. The market, we feel as though the market is likely to be oversupplied in the medium term, but we know that the copper market has something of a history of project delay, and there's a reasonable likelihood that some of this supply will be delayed in coming online. And my next couple of slides will demonstrate how this has unfolded in the past. And here we see a column chart of a snapshot of 15 projects which in late 2011 were expected to bring near on 1 million tonnes of copper in concentrates by 2014. And this is as per the company's guidance. And then over the period of 2013 to the start of this year, the same 15 projects have been deferred, some pushed out, in our opinion, up to 2020. And BHP's decision to delay or indeed essentially cancel their Olympic Dam expansion programs has removed 400 kilotons from the market entirely. So looking a little bit further on the demand side, construction is expected to remain reasonably level, with the developed world markets requiring some level of rebalancing before we see material increases. Some statistics there indicating that the US and Japan will moderate into next year, and China taking some measures to try and take some of the heat out of their property sector, which is considered to be in some level of overhang. That said, Indian construction growth is expected to be somewhat expansionary next year, and broadly we expect to see some level of growth throughout the developing world in the construction sector. Transport is probably the area in which we're seeing the most potential for growth. The country particularly moving away from that would be Japan, which has been particularly volatile in recent years between some of their natural disasters. But looking forward, they've the introduction of a new consumption tax was expected to take some of the growth out of their market next year, and that we believe there's been some delay in how some of those consumption taxes are being rolled out in order to keep their domestic car market bouncing along. But otherwise, we see transport as being very much one of the stronger areas for copper demand going forward, particularly with the advent of electric vehicles becoming a lot more prevalent and requiring something like a doubling of copper required on a car-by-car basis. Consumer durables, we expect a demand growth of 2.1% over the next 15 years. which is typically more cyclical, given that a lot of these purchases are a lot more discretionary. The unemployment is still hovering around its highest levels throughout the developed world, although some strong recovery in the US has probably spurred some of this along, notwithstanding that the housing slowdown has probably taken some of the heat out of that. But Chinese growth is expected to be reasonably robust over the next couple of years as urbanization rates continue to climb and salaries probably go through sort of moderate climbs as well. We've seen statistics which suggest that that even in what's classified as rural areas in China are still showing fairly high TV saturation, for example, and even some of the white goods are appearing to be fairly prevalent throughout rural regions. Wash machines, refrigerators are present in something like 2/3 of rural homes, as it is at the moment. But we're still expecting there to be some level of replacement demand going through the market over the next couple of years. So this is our cost curve for the projects which we have in our database. We estimate average copper mine cash costs to be at around $1.50 per pound, which sees the better part of the cost curve operating at below the current $2.90 per pound copper price. So something in the order of 97% should still be seeing some level of profitability at the moment. We've seen a fairly strong increase in copper mine cash costs over the last 5 years, something in the order of 48% since 2010, primarily in a cost of the inputs, consumables, energy and labour. Highest cost projects up the right hand side are typically those which are aging, that only extract sulfide ores without the relatively easy copper oxides that are quite accessible, that typically sit near the sea. And the far left-hand side of those which enjoy the exceptionally high byproduct credits, such as Norilsk in Russia with their nickel credits, and all throughout the Glencore operations, and Peak, who have fairly sizable gold credits. On a country level, obviously see Chile dominating in the middle there. So as I said, the highest cost producers are those older ones that have less in the way of byproducts. The right-hand side of the cost curve is typically dominated by small mines with low throughput, and which have very little in the way of byproduct revenue, or suffer from particularly high transport costs. And typical countries here, as you can see, Kazakhstan, Namibia, Botswana, South Africa. Botswana's likely to near on fall off altogether with the cessation of the Posito project by Discovery Metals. Down the left-hand side, we see some of the European countries, Russia, Finland, Bulgaria, which have very large copper credits, and are broadly polymetallic deposits. with great revenue streams. Indonesia has returned to the bottom end of the second quartile, but to Hyde Grasberg returned to exporting back in the second or third quarter this year. China's cash costs have increased over the past 5 years to make it over 36th out of 43 countries in being the most expensive. Labor costs and heavy taxes, royalties are really adding to the cost side of the story there, and minimal sort of byproducts working to reduce those costs. So looking forward in 2019, our country cost curve, we see Peru very much widening up down the left-hand side and occupying a large part of the first quartile, and this obviously has a lot to do with First Quantum bringing on Cobre Panama. Sorry, that is in Panama. You'll see that further down on the left-hand side. Peru, the Toromocho deposit will have a lot to do, and Las Bambas as well with how Peru performs in the future. The US will become a second quartile producer after being a fourth quartile occupier, essentially swapping places with Australia as Australian assets become older compared to some of the newer assets ramping up in the US. Importantly, we see Indonesia becoming a lot more expensive as Grasberg becomes predominantly more an underground operation. So moving into our production costs and price forecasts for the next couple of years. We've seen production costs increase significantly over the last decade, coming up through the boom of the early 2000s. Now the commodity prices have entered the next stage of the cycle. There'll be a sustained focus on cost reductions, which are under control of the mining side. The next 10 to 15 years will see pressure on mining and processing costs as labour with labour efficiency improvements, as well as some operations attempting to target some of the high-grade areas of their operations. As I mentioned earlier, we expect to see TCs and RCs to climb. However, we don't see this necessarily as being as significant as currently believed by operators of copper smelters, and the increase is likely to be somewhat short-lived. High pricing levels reached during the mining boom, which was somewhat delinked from production costs, are not expected to occur into the future. That said, we're still expecting 7,500 per tonne price into 2016. So just to finish up, one thing we see sort of underpinning the copper price will be, just waiting for, there we go, will be the decline in head grades coming out of global operations. Between 2004 and 2014, we had a grade drop from 0.78 to 0.65%, which is a 17% relative fall. Average grades split between sulfide and oxide deposits sulfide deposits have dropped by roughly 25%, and whereas oxide grades have actually increased by 8% over the same period. So falling grades will remain a defining feature of the copper market. This is underpinned by the very large South American deposits, which are coming very much a feature of the supply profile over the next few years. That and worldwide, the highest grade mines are maturing, and towards the end of their mine life, will begin to mine successively lower grade areas of their deposits. And as I said, at the same time as that's happening, lower grade ore bodies will be coming online. Oxide ore grades are on average lower than sulfide ore grades, but the accessibility of oxide ore makes it something of a viable option to still process these deposits. As I mentioned, the oxide ores are extracted from large-scale, low-grade Chilean mines, which have very large, consistent ore bodies, which have not had the same rate of, well, the oxide grades at least, have not had the same rate of grade degradation as the sulfides. Added to this, the prevalence of solvent extraction leaching technology has effectively assisted miners to process the smaller, higher grade oxide deposits, which were generally deemed unviable in the past. And that's where I'll finish up and hand back to Carly for any questions.
Thank you, Andrew. Let's see here if we've had any questions come in. So yeah, everyone, if you've got a question for Andrew or a question for Richard, I know that they've given us a lot of really good information. Feel free to go ahead and submit those using this toolbar here. We'll see if any come in. Otherwise, we have Andrew and Richard's contact info for you. We'll go ahead and advance here to our next slides with the contact information. Let's see. And drop that back in there. And make sure I've got... Okay. All right. So, and Greg was going to jump on the call with us today with Richard and give us a brief little bit of brief information about GE Capital, but he wasn't able to actually make the call after all. But if you have any questions for him, or you have any questions for Richard about the information that you heard today, go ahead and reach out to them. We've got their website on here for more information about them as well. And then on the following slide, we have Andrew's information. So thank you, Richard and Andrew, for being with us today, and thank you again to ABC Metals for sponsoring our presentation. This is always, I think, one of our most highly anticipated presentations of the year to figure out, what's going on in 2015 and, what our industry can expect to see. So for everyone who's on the call, you will get, like I said, a survey here in about an hour. Please fill that out for us. It does help us decide, what topics we're going to present in the future, and as well, once you complete the survey, then you do get a link to these PowerPoint slides. So I know being a Friday afternoon right before the holiday, people may not be in the office and that kind of thing, so feel free to share the slides with others. I will get the recording of the webinar posted, again, to CAPSA's website, and get an email sent out to you to let you know whenever that recording is out there. So if we don't have any further questions from anyone, then Richard, Andrew, do we have any final thoughts from you guys?
Not for me, thanks.
No? Okay.
Just happy holidays to everyone.
Yeah, happy holidays to everybody. Thank you again for being with us. Thank you again to ABC Metals. And we hope to you have a wonderful holiday, wonderful new year, and we'll talk to you in the new year. So thank you and goodbye.
Great. Thank you. Bye-bye.
Thanks, Carly.
Thank you.
Cheers, Richard.
Thanks, Andrew.
No, you're welcome. Bye-bye.